Welcome to Kitco News. I'm Niels Christensen. Better than expected economic data is creating some optimism for a sharp recovery in the global economy, devastated by the COVID-19 pandemic. However, is that optimism misplaced? Here to talk about his outlook for the global economy is David Rosenberg, chief economist and strategist at Rosenberg Research and Associates. David, it's always nice to get your insights. Let's just jump into this. We've seen better than expected economic data, job numbers being one of them. Is there anything that is making you change your mind about the economic outlook? Last time we talked, you said, there's really nothing to generate a substantial recovery in this economy. Has anything changed for you?
Well, look, I think that there's no question we're going to get some sort of recovery into the third quarter. But I don't think that, the question itself can't be asked without a little bit of perspective. Because if you go back 3 months, I think everybody knew that the second quarter was going to be horrible. But most people were talking about, real GDP in the U.S. down something close to 20% at an annual rate, which alone is a depressionary number. And now you're looking at estimates that are between down 40 and down 50% for the second quarter. We don't have quarterly data for the Great Depression, but I'd hazard to say, looking at the annuals, that this is at least as bad as anything you saw in 1930, 31, or 32. So, to be talking about a recovery coming off of a detonation, that's not a brave forecast. I think even the most ardent bear, and maybe you would classify me as that, would say that, yes, we're going to get a check mark. It's not going to be a V, but, it's so bad in the second quarter, that you can be up 20% at an annual rate in the third quarter, and you didn't even barely recoup half of the carnage in the second quarter. So it has to be looked at, in that context. And, the only thing I would say is that, people look at the action in the stock market and then they fit that narrative into what they're seeing in the economy. I would actually take issue with a couple of things that you'd mentioned. Yes, retail sales came in far better than expected. And maybe it shouldn't have been that big of a surprise when you consider that in the month of April, the U.S. government handed out $3 trillion at an annual rate of transfers of all kinds to the personal sector, to pretty well everybody, whether you're working or not. $3 trillion, and that's benchmarked against organic wages and salaries, which declined $740 billion at an annual rate because many of us weren't at work or getting paid. So think about that for a second. In a month where we lost 20 million jobs, in April, personal income still went up 10% because government transfers went up 90% in 1 month. Unprecedented. It would have made FDR blush. And that was $3 trillion at an annual rate of handouts from the government to the personal sector. So then why wouldn't anybody think that if you're going to get free money from Uncle Sam, keeping in mind that a lot of people that are unemployed are actually making more money now than they were before the crisis. Mm-hmm. So that's the extent of the stimulus. So, you're going to come to me and say, oh, well, look at these wonderful numbers, but this is not organic wage-based income. This is $3 trillion at an annual rate in the month of April. Look it up. And a good chunk of that got spent in April, I imagine, or in May. There'll be spillover, into June. But that is basically charity money from Uncle Sam to keep social stability intact, and that money went into retail sales. That much is true. But actually, today's housing start number looks like a speck of dust. That rebound in May, in fact, in single-family construction, there was no rebound at all. There was no recovery, actually, in housing. Industrial production numbers came out the same day as retail sales. The whole raise was retail sales, and no comment to the fact that industrial production came in dramatically less than expected. And that is looking like a very deep recession that's ongoing. That was surprising, is that as the economy reopened in May, there wasn't a lot of growth on the supply side of the economy. But then again, look, the government is not giving out handouts to the business sector. Oh, well, the Fed may be buying their bonds, and there may be PPP grants and loans to keep businesses intact. But businesses are not being given money to really spend outside of forbearance and outside of paying their workers. But the people got a nice big fat check from Uncle Sam, and they spent a good chunk of it in May, and that was the story. And that's why the retail sales numbers were so decent. But I'd actually say since then, industrial production and housing starts both came in below expected. But you see, as long as the stock market's going up and up and up, the people are going to believe that's got to mean that the economy is doing great. But the Main Street and Wall Street are as disconnected as they've been at any other part of this whole past 12 years. And it's as evident today as it's been last year, the year before that, or the year before that. I mean, the stock market was up 30% last year. You would have thought we had an economic boom. GDP growth was barely better than 2%. So just this ongoing support by the Fed and liquidity and quantitative easing on steroids, and that's giving you a stock market rally in the context of the worst economy since the Great Depression.
So then what advice do you have for people trying to navigate these waters that are artificially chlorinated, I guess, with Fed money and stimulus? And, I agree with you. I mean, the stock market rallied 40% off the March lows. And I just even if 90% of the jobs come back, you're still looking at millions and millions of people unemployed. And it feels like nobody is really taking that into account. They're just looking at the stock market. So I'm sort of wondering, how do you navigate these artificial conditions?
Well, look, if you're a trader, I guess you just want to trade around the Fed balance sheet or trade around Fibonacci reversals and the technicals in the market. But, if you're an investor, you're really left with a choice here. And I think the choice is, are you going to be a growth investor or a value investor? I would love to be a value investor, but for the value investor, you need to have inflation. You need to have a bear steepener of the yield curve. You have to have re-accelerating global economic growth. None of those things are happening. So I think what you want to do is you want to look at what the world is going to be once we get past this crisis, how things are going to change. Mm-hmm. And I would say that, it's not just a question over government policy, but at the individual level, I'd say that months of isolation and distancing, now the fear of the return of the pandemic is now coming back in 24 states. But I think that we've undergone a shock here that's going to fundamentally alter lifestyles and I think have a profound influence not just on the way we live, but on how we conduct ourselves in our commercial and business lives. So, I'd say, if you're looking for how you invest, you got to invest around the view that we had a shock, and it might have been a short shock. Not every shock's got to be a long shock, but it's a shock that I think has going to have longer-term ramifications. And by the way, we're not going through a second coronavirus wave here in the States. There's 24 now in the United States, and Florida is at the epicenter. And of course, the governor says that, well, we're not going to close down again, and the U.S. isn't going to shut down again. But this is just basically, we're still in the first wave of this thing. Mm-hmm. And it's nice to talk about steroids, reducing mortality rates, and until we get a vaccine, nothing is going to return to normal. And then after that, the question is going to be, how much changed in these last several months? Let me give you an example of what I'm talking about. I think that working from home is going to become a much more dominant force. And if it's a much more dominant force in the labor market, it's going to be a much more dominant force, I think, in the investment market. So I think that no matter how you're investing today, and maybe if you're buying the ETFs or the major averages, go right ahead. I'm a thematic big ideas guy, and even though I'm bearish on the stock market, there's always ideas and always kernels within the market that I'm actually telling people to buy. You don't have to buy all 500 companies in the S&P 500 unless you're completely lazy, okay? That's all you're doing. You're buying 500 stocks, and at any given moment of the time, 400 of the 500 you'd rather not own. Mm-hmm, mm-hmm. So people talk about the market, but the market's is a portfolio. What stops people from being creative, from doing the homework and creating your own portfolio. Why do you have to go create the S&P 500? So I would say that, for example, in the future, the work-at-home theme, or what I call the homebody economy, is going to be negative for commercial real estate. Why would you want to have that in your portfolio? Wouldn't you not want to have that in your portfolio? Wouldn't you rather have that S&P 500 excluding commercial real estate and all the areas connected to it? It's going to be in a secular bear market. But then again, positive implications for internet infrastructure, computer hardware, video conferencing. There's going to be a sharp reduction in travel to work. I think travel in general. And this doesn't just mean fewer cars on the road, which is bad for the auto sector. It also means, as I said before, lower demand for office real estate. And then there's going to be the situation where, let's face it, let's learn from this pandemic. Let's learn about what happened here. Why did all these people need all these extended handouts from the government? Why? Because over half of the household sector went into this crisis with no savings. Well, think about that for a second. How's that even possible? Do people actually, you do have an insurance policy on your house, right? Because we tend to be risk averse. People that need all these handouts, didn't they save for the rainy day? And of course, we got the storm. So we're going to come out of this situation with savings rates in the consumer sector in a much higher range than they were in the past. And that's going to be very important because it tells me that, do I want to actually be long consumer discretionary stocks? No. Why? So why do I have to buy the S&P 500 when I don't want to own 15% of the index called consumer discretionary? So I think that what you want to focus on is where people, and the people who make up the economy, you want to focus on what they need, not what they want. That's really the portfolio you want. You want to short what they want and go long what they need. So I actually found it again, because economics inherently is the study of behavior, and in this case, say, consumer behavior. And I found it fascinating that over the past 3 months, before the lockdowns ended, where consumers spent whatever money they had, besides canned food and toilet paper and booze, were things like garden supplies, jigsaw puzzles, bread makers, anything related to e-commerce, cloud services, wiring up your office, your home to become your new office. That, I think, is actually how you want to be constructing your investment thesis. So I actually believe that delivery services aren't cyclical anymore. They become an essential. So you have a budding bull market right there for Amazon, any business model that copies it. You know, I tack on grocery chains with online services. To me, they come out a big winner here. So the shifting behavior that was already taking place, that tells me to focus on consumer staples, and I'd say in other areas of the market that are necessities. I'd say healthcare. I'd say even big tech. Big tech in this whole process is being re-rated as being essentials. So can someone argue, has Microsoft become a utility? I think you could probably argue that. Has Amazon become a utility? I think that question's been answered. I think you could probably argue that Google may have become a utility. So I'd say that you want to have access to the necessities, and it's not just in the consumer staple space, but you can gravitate towards big tech. And it's also apparent to me that you want to have exposure to healthcare as we come out of this, once again, knowing that this was an underinvested area, and I think without a shadow of a doubt is going to become less regulated in the future. So these are the sorts of things when you're asking me about, what are the investment thesis? And I would say that, look, if we're talking about the central banks, I say that one of my key investment ideas for the state of the world we're in is gold. And we can talk physical gold, talk about the gold miners where you'll get the leverage. But, I know that we spoke in our last show about the instability of the extremes of deflation and inflation. Don't get me wrong. Inflation will come way down the pike. I think that you asked me before about, about the inflation call. I think I'd mentioned the inflation call is, it's like talking right now about dessert as they're serving the appetizers. I think right now we have the extreme of deflation. It's continuing. And what it tells me is that interest rates are going to remain low or maybe go even negative. And that's going to make the opportunity cost of holding gold nil. So I'd say that if there's inflation, gold is going to do well as a classic store of value. And I'd add that all this central bank alchemy has led to these ever increasingly unstable markets. And we have to realize that volatility works in both directions, up and down. And I think that gold is going to do very well against this backdrop.
So then, if you and this is, you actually been bullish on gold. We've been talking at the start of the year. You were bullish on gold. You saw a place for gold as just debt issues started getting under control, and we've seen that just being blown right out of the water with all the stimulus measures. And I'm sort of wondering, what are your thoughts then on miners? You just said, it's a leverage play. Do you like the miners in this environment?
Yeah, sure, I do. And that's when you get the leverage. And look, I want to make this point that, I want to bring your attention to this report that the San Francisco Fed did a couple of months ago. It's the San Fran Fed. They are the first Fed district bank at the Fed that I go to every week for their research. It's really quite good. They published a report that was titled Longer Run Economic Consequences of Pandemics. They must have a great research budget because their economists went back to the 14th century and they assessed the 15 major pandemics going back to that period. And what they found, and I'm going to sound a little professorial here, teaching Economics 101, but they found a secular shift in two very important curves if you're forecasting interest rates. A secular shift towards greater precautionary savings, which, by the way, I just talked about. But at the same time, because companies focus intensively on their cash position and balance sheet quality, what you find is that investment demand also goes down. So they found that the impact of these great historical pandemics of the last millennium was to push down what economists call the natural rate of interest, or you've heard, the Fed call it the neutral rate of interest. For the years that followed the pandemic, the nature of the curve on savings and the curve on investment takes the natural rate of interest down 150 basis points, lower than if the pandemic had never happened. And maybe that's why we can't rule out negative interest rates, which, by the way, they're openly contemplating in the UK. And especially because you got to consider the starting point this cycle on where yields were already a fraction of 1%. So, I'll just read you the conclusion of that San Fran Fed report. In quotes, following a pandemic, the natural rate of interest declines for decades thereafter, reaching its nadir about 20 years later. At about 4 decades later, the natural rate returns to the level it would be expected to have had the pandemic not taken place. History shows that real neutral rates can be depressed for 5 to 10 years. So here's what I'll say to you and to all the people on the line, is that if this is not an advertisement for gold, I don't know what is.
And I guess their forecast for interest rates to stay at the zero bound for the next 2 years, that feels a little bit optimistic after listening to that research. Wow.
Well, it's going to be even longer. Look, the Fed, we always have to take the Fed's forecast with some grains of salt. Mm-hmm. The latest forecast gave us a whole lot of information. They basically told us that the funds rate is going to be on hold for the next 30 months. I think it's going to be a lot longer than that. They've got inflation going from nothing to 1.6%. Of course, they want to see 2%. So they're telling you, well, we're not going to be at our price stability goal. But what they're telling you is that in their forecast, inflation is going to be rising gradually at a time when they're going to pull the funds rate close to zero. And that is a prescription for negative real short-term interest rates. And real short-term interest rates have a time-worn 90% inverse correlation to the gold price. So as much as I'm convinced about anything, it's where gold's going to be heading and what the appropriate correlations are. The other point here is that, the Fed is telling us that their forecast for the unemployment rate now for the end of 2022 is 5.5%. Before the crisis, their estimate was 3.7. So that's quite a big shift. You're going to say, well, wow, will we ever get to 5.5 even? Well, it's just a forecast. What's more important here is that they continue to believe that the natural rate of unemployment or full employment is 4.1%. And they're telling you that we're not going to even get to 5.5 by the end of 2022. So they're telling you there's still going to be this lingering output gap, which is why they're going to have rates close to zero for many years to come, I think, beyond just 2022. And then the question becomes, what else is up their sleeve that they haven't done yet? And, of course, they're talking more openly now about yield curve control strategy, which is something they actually did do from 1942 to 1951. When they don't just cap the funds rate, they cap yields right out the curve. Well, this is one reason why I still like treasuries, because I'm sure when they fix yields out the curve, it's going to be at a lower level than it is today. But don't you see, everything continues to work towards a secular bull market in gold premised on where interest rates are going. And I guess you'd say to me, well, but why don't you like the equity market? Well, there's parts of the equity market that I like. So I guess I'll just say that so long as you have the view that rates remain lower, go lower, it's not going to be good news for the value players. The value stocks will not do well in a lower rate environment. The financials, how will the financials do well in a zero interest rate, flat yield curve environment? Their net interest margins will be crushed. There's no earnings visibility in the financials. And what this means for insurance companies and pension funds, not good news. But, the growth, like when I'm talking about big tech with strong balance sheets, growth companies, by definition, have much longer duration assets than value companies do, and they will benefit more on a discount present value basis from these low rates than the value trade. So I'd say that within the stock market itself, when you're picking apart things that you like, it's growth over value, and also interest sensitives like utilities. And I would say like telecom companies that have financial depth. I said before I don't like office REITs for obvious reasons, but multifamily REITs, or I'd say not multifamily, but residential REITs in general, industrial REITs, might be good places to be, again, for the stability of their yield in a 0% rate environment. So that's really what falls out of all this.
David, this has been a fantastic conversation. I always learn so much when I talk with you. Thank you again for the Econ 101 lesson. And thank you very much for your passion. It's been a really pleasure listening to you today. Thank you very much for your time.
Well, thank you as well. And anybody who wants to get on the Rosenberg Research website, just go straight to the Rosenberg Research website, information at rosenbergresearch.com.
Thank you very much for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.